The Amazon Q3 2025 earnings call transcript.
We deeply appreciate you trusting us to synthesize this incredible density of information. I mean, Amazon is such a vast, multi-headed enterprise, and these quarterly calls often feel like trying to drink from a fire hose.
That's the perfect analogy.
Our goal today is to provide you, the learner, with a structural understanding that serves as a shortcut to being instantly and deeply informed.
That's right. And before we dive into the data, we have to handle a few key housekeeping items. If you find this exploration helpful, if it saves you hours of reading and synthesis, please take a second right now to like this deep dive.
It really helps.
Share it with someone else who needs this kind of insight, and of course, subscribe to our channel so you don't miss our future breakdowns. Stay tuned, because the next half hour or more is going to deliver a complete understanding of where Amazon is betting its colossal capital, specifically in the AI space.
And our mission is meticulously structured. We are unpacking the full transcript, separating the prepared remarks delivered by CEO Andy Jassy and CFO Brian Olsavsky from the rigorous analyst Q&A session.
And that structure is so important.
It's critical because the prepared remarks tell you the narrative the company wants you to focus on, but the Q&A session, which we will dissect analyst by analyst, reveals where the sharpest strategic focus and, frankly, the competitive vulnerabilities actually lie.
Right.
Get ready, because the narrative is clear. This quarter was defined by an unprecedented bet on AI infrastructure capacity.
Okay, let's unpack this $180 billion quarter and understand not just what they achieved, but why that achievement is fundamentally changing the company's trajectory. So starting with the top line, the scale is, it's exactly what you expect from a company of this size.
Yeah.
Amazon reported $180.2 billion in worldwide revenue for Q3 2025.
An incredible number.
It is. That's a very solid 12% increase year over year, or YoY if we exclude the positive impact of foreign exchange fluctuations. It indicates steady, persistent growth.
It does, but immediately the key nuance for you to grasp is in the operating income line. They reported $17.4 billion in operating income. Now, on its own, that sounds phenomenal.
It does.
However, this quarter included two specific, significant, and non-recurring charges totaling a staggering $4.3 billion.
$4.3 billion.
Yes, and Losovsky made sure this is the first detail he presented because it fundamentally changes the perception of core operational health.
Okay, so that is a massive amount of charges to book in a single quarter. If we back those out, what does the true underlying operational picture look like?
All right, so the true operational operating income, the money generated by running the actual retail, cloud, and logistics businesses, would have been $21.7 billion.
21.7.
And here is the critical context. Amazon's own guidance range for the quarter topped out below that figure. Operationally, the business performed $1.2 billion above the high end of their guidance range.
Wow.
So this is the central financial takeaway. Despite massive external economic pressures, the core engines of the business were running hotter than even management expected, which provides crucial capital for their strategic investments.
Let's talk about those charges in detail, because $4.3 billion is substantial. How is that broken down, and why were they booked this quarter?
It was broken down into two main components. The first was a $2.5 billion charge related to an FTC legal settlement. This was recorded specifically in the other operating expense line item within the North America segment.
Okay.
It's basically a cleanup item the market had anticipated, and management chose to book the full estimated cost in Q3 to clear the deck.
And the second charge. That directly relates to the sweeping efficiency measures and organizational restructuring that Andy Jassy has been implementing over the past year.
That's it. That's the $1.8 billion charge booked for estimated severance costs related to those recent role eliminations. What's important here is how they booked it.
How so?
This severance expense wasn't just siloed in corporate. It impacted all three core segments: North America, International, and AWS.
Ah, okay.
It was distributed across technology and infrastructure, sales and marketing, and G&A lines. This ensures that when analysts look at the operational profitability of those individual segments, the true cost is reflected accurately. It shows they are serious about having cleaner, leaner operating metrics moving forward.
If we move beyond core operating results, the cash and investment numbers were also massive, particularly in the net income line, which got a huge non-operational boost.
Precisely. We look at free cash flow, or FCF, which is the cash generated after all capital expenditures. The trailing 12-month FCF was $14.8 billion. But the net income for Q3 exploded to $21.2 billion. Now, this is where we have to clarify the numbers for you. That figure is significantly inflated by a single strategic paper gain of $9.5 billion.
And that gain ties to their strategic investment in Anthropic, the AI company, doesn't it?
It does. Olsavsky was very specific.
Mm.
This is classified under non-operating income. While it's a tremendous paper win and speaks volumes about the aggressive valuation of their AI partners, it is not cash generated from selling products or cloud services.
Right. It's a key distinction to make.
For the learner, the key takeaway is to separate the $17.4 billion operational income, which was strong, from this $9.5 billion investment gain, which is, much more volatile.
Looking briefly at the segments, North America revenue hit $106.3 billion, growing 11% YoY. International revenue was $40.9 billion, growing 10% YoY, excluding foreign exchange. Where did we see the margin strength outside of the U.S.?
In the international segment, their operating income was $1.2 billion for a 2.9% margin. Olsavsky noted that if you back out that severance charge, the international operating margins actually expanded year over year.
So the investments are paying off.
It confirms that the immense multi-year investment they made in building out localized fulfillment networks around the world is finally paying tangible, profitable returns. I mean, this segment used to be a drag on profitability, and now is showing real leverage.
Okay, so that covers the core business. Let's pivot to the engine room. AWS, this is where the strategic focus shifts dramatically, and the scale of their commitment becomes, well, almost unbelievable.
It really does.
AWS reaccelerated significantly, hitting 20.2% year-over-year growth. That's the largest growth rate they've seen in 11 quarters.
And that 20% growth rate is an incredible indicator of market momentum, especially when you factor in the sheer size of the base. AWS Q3 revenue was $33 billion,
Another $3 billion in one quarter.
which represents an increase of $2.1 billion quarter over quarter. That puts AWS on a $132 billion annualized run rate.
So on that kind of scale, how significant is a $2.1 billion quarter-over-quarter increase? I mean, is that standard, or does that indicate a genuine, unexpected acceleration?
Oh, it's a major acceleration. To put that in perspective, that $2.1 billion QOQ gain is larger than the entire annual revenue of many successful public cloud companies.
That's a great point.
And Andy Jassy made a point of noting that achieving 20% growth on a $132 billion base is, quote, very different than posting a higher percentage growth rate on a much smaller annual revenue base.
A direct signal to competitors.
Absolutely. Emphasizing that AWS is the entrenched leader where growth compounds into astronomical dollar figures, demanding huge capacity. And operating income for AWS was $11.4 billion, reflecting continued high margins, even while funding this massive AI infrastructure build-out.
And that word capacity leads us to the single most consequential financial number in the entire transcript, the CapEx bet.
This number is the core takeaway for you, the learner, bar none, because it defines Amazon's strategy for the next 5 years. Amazon expects its full-year cash capital expenditure, or CapEx, to hit approximately $125 billion in 2025.
Wait, $125 billion?
$125 billion, and this expenditure is driven heavily by the soaring demand for AI infrastructure, and the conviction is so high that they explicitly expect the CapEx amount to increase further in 2026.
So they are not constrained by demand. They are constrained by their ability to physically deploy capital. This is essentially an unconstrained bet on AI infrastructure, stating they will spend whatever it takes.
Absolutely. It is the definition of a multi-year, multi-hundred billion dollar commitment to owning the future of AI compute. It demonstrates confidence that they will monetize this investment very, very quickly.
And this CapEx translates into physical reality, most notably power capacity. The scale is difficult to grasp.
It is. Jassy revealed they have added more than 3.8 gigawatts of power capacity in the past 12 months, more than any other cloud provider.
3.8 gigawatts.
To put that in context, that is roughly the power generation of 3 or 4 large nuclear power plants.
Yeah.
It is enough to power a major metropolitan area. They're building a physical utility network that is unmatched.
And it's a compounding advantage.
It is. They are now double the power capacity AWS had just in 2022, and they are on track to double again by 2027. They expect to add at least another 1 gigawatt in Q4 2025 alone. They are building a moat based on electrical infrastructure and physical geography.
Moving from the physical capacity to the brain power, let's discuss their custom silicon strategy, Annapurna Labs, Graviton, and the Trainium series for AI. This is where the competitive differentiation starts to play out aggressively.
Right. And the transcript confirms massive customer commitment. AWS's backlog, the contracted future revenue, grew to $200 billion by quarter end.
$200 billion.
And even more telling, Jesse mentioned that this backlog doesn't include several unannounced new deals that were signed in October, which together are larger than the total deal volume for all of Q3. The demand curve is steepening aggressively.
And the current execution engine for their custom AI chips is Trainium 2, which seems to be fully leveraged already.
It is fully subscribed. Trainium 2 is now a multi-billion-dollar business that grew 150% quarter over quarter. But the scale of their commitment to Anthropic, one of their key partners, is colossal.
This is Project Rainier.
This is Project Rainier. Jassy revealed they recently brought it online. It's an enormous, bespoke AI compute cluster spanning multiple U.S. data centers and containing nearly 500,000 of their Trainium 2 chips.
500,000 chips.
And this cluster is expected to reach over 1 million Trainium 2 chips by year-end, dedicated solely to Anthropic's Claude model development.
That is a staggering concentration of customized power for a single partner. It makes a strong statement about their custom silicon, but that focus, it introduces massive concentration risk. What was the company's defense for such a heavy bet?
The defense is that this bet proves the infrastructure works at a massive scale, which is exactly what other large customers want to see before committing. But the ultimate goal isn't just training, it's inference. Jesse made a profound statement that frames the long-term vision. Their goal is for Amazon Bedrock, their generative AI service layer, to be the biggest inference engine in the world.
Bigger than EC2, even.
He went further, expressing the long-run belief that Bedrock could be as big a business for AWS as EC2, which is the foundational compute service of the modern cloud.
Wow.
And the majority of token usage in Bedrock is already running on Trainium, proving that vertical integration is working to drive down the cost of high-volume inference.
So we're not just talking about infrastructure, we're talking about application. The commentary on AI agents suggests they aren't just building the pipes, they are delivering the applications that sit on top.
And they provided 4 powerful examples of agents already delivering real, practical, and monetizable results. This isn't theoretical. This shows AI is already driving profitability.
What were they?
Okay, first, Curo for coding. It's in preview with over 100,000 developers. Second, Transform for migration. It saved customers 700,000 hours of manual effort year to date. Thomson Reuters used it to speed up code transformation 4x.
4 times faster.
Third, Quick Sleep for business customers. It's turning month-long analysis projects into days. And fourth, Connect for contact centers. It just crested a $1 billion annualized revenue run rate. In the last year, 12 billion minutes of customer interactions were handled by AI.
That list is concrete evidence. AI isn't just a CapEx line item for training. It is already driving efficiency and revenue across multiple billion-dollar business units. Moving to the core retail side of the business, which is still the largest segment by revenue, the focus remains on selection, low prices, and convenience. Selection has increased by 14% since last quarter.
And the underlying strategic shift here is the focus on everyday essentials, which is growing nearly twice as fast as the rest of the business.
Which leads us directly to the game changer in their retail strategy, the same-day perishable grocery overhaul. What's the status update on that?
This is a crucial strategic shift away from the traditional model of requiring separate, dedicated grocery stores. Customers in more than 1,000 cities and towns can now shop fresh groceries alongside millions of Amazon.com products with free same-day delivery.
So they're leveraging the existing network.
Exactly. It's a massive logistical achievement. You can order milk alongside electronics and have everything delivered within hours.
If this efficiency push is reducing costs in retail, where is the most profitable offset? Let's talk about delivery speed first, then pivot to ads. They are committed to the fastest speeds ever for Prime members.
Yes, the obsession with convenience is paramount, and sometimes the simplest innovations have the biggest impact. Jesse highlighted the new Add to Delivery button.
Simple, but powerful.
Incredibly. Since launch, this feature has been used more than 80 million times. That is a powerful anecdote that shows how micro-innovations focused on friction reduction can drastically increase customer loyalty and stickiness.
Okay, now let's pivot to Amazon ads, the segment that consistently delivers high-margin profitability.
The advertising segment delivered strong growth, generating $17.6 billion in the quarter, an acceleration of 22% year over year. This success is not accidental. It's rooted in their comprehensive, full-funnel offering.
And they are also making huge moves to extend their reach beyond their own platform through strategic partnerships, making their demand-side platform, or DSP, a serious competitor.
Exactly. They detailed significant expansion for their Amazon DSP. Building on their Roku partnership, they announced an integration with Netflix,
Wow, Netflix.
giving advertisers direct access to Netflix's premium ad inventory. Furthermore, they integrated with Spotify and SiriusXM. This shows that DSP is maturing into a highly competitive multi-channel platform.
And finally, we need to touch on the quick hit innovation updates that demonstrate momentum outside of the core segment.
Okay, rapid fire. First, Prime Video Live Sports. The NBA on Prime tipped off with a double-digit increase in viewers. They're adding the Masters and PGA Tour.
Second, Alexa Plus.
The upgraded experience is working. Customers are interacting 2x more, and shopping conversations ending in a purchase are 4x higher.
Project Kuiper.
Over 150 satellites in space, delivering over 1 gigabit per second speeds in tests. It's getting real.
And lastly, Zoox.
Their autonomous robo-taxis are now available to riders in Las Vegas, with DC announced as the 8th testing location. Steady expansion.
That concludes the prepared remarks. A massive overview, but the core theme is undeniable. AWS is re-accelerating, fueled by AI demand, which is, in turn, driving unprecedented, unconstrained capital expenditure.
That's right. Now let's transition into the Q&A session. This is where we get the unvarnished strategic insight forced by the focused questions of the analysts.
We will proceed through the Q&A session analyst by analyst, covering the question summary and the company's strategic response in detail.
Our first question comes from Justin Post, a managing director at Bank of America.
Post was focused squarely on AWS capacity. He asked about current constraint levels and specifically dug into demand for Trainium outside of the mega customers.
Andy Jassy's response was explicit. Capacity is constrained. But he immediately clarified that this is due to the sheer velocity of the acceleration in demand, not a failure in planning.
So it's a good problem to have.
Exactly. He reiterated the core competitive edge of their custom silicon, stating that Trainium 2 is proving to be 30% to 40% more price performant than competing options. This is a critical factor driving massive demand, especially for inference.
If capacity is constrained even for their biggest partners, what does that mean for the smaller customers who want to use their custom silicon? Are they just out of luck for now?
For now, yes. He confirmed they are prioritizing the highest demand areas, which currently means the very large customers are getting Trainium 2, citing Project Rainier as the prime example. However, he promised that Trainium 3, which is set to preview at the end of 2025, will be designed to accommodate a much broader range of interest.
Next up, we had Brian Nowak, Managing Director at Morgan Stanley, who posed a fascinating, high-level philosophical question about the custom chip strategy itself.
Nowak wanted to understand the key hurdles for Trainium 3 adoption. How does AWS broaden that adoption versus relying on third-party chips? This question gets right to the heart of the risk management strategy.
And Jesse's response was crucial because he was very clear about the strategic importance of having multiple options and not relying solely on their own silicon.
He was unequivocal. He stated AWS will always offer multiple chip options because it is rare for any single player to dominate. And crucially, he reinforced their commitment to their biggest partner, stating they maintain a deep, unconstrained relationship with NVIDIA.
So they expect to buy more from NVIDIA next year.
More from them next year, and will continue to grow relationships with AMD and Intel.
So if they are buying massive volumes from competitors, why the multi-hundred-billion-dollar internal investment in Trainium? That seems contradictory.
It's purely about that competitive advantage through price performance. Jassy compared Trainium to their custom CPU, Graviton, which offers about 40% better price performance. He said Trainium provides a similar 40% price performance benefit.
And Trainium 3 will be even better.
He then made the bold claim that Trainium 3 is expected to be another 40% better than Trainium 2. That consistent 40% advantage is a huge sustainable moat.
That context sets up the third question in this round perfectly from Doug Anmuth, a managing director from JP Morgan, who wanted more specific details on the Project Rainier architecture.
Anmuth's question was highly specific, focusing on the infrastructure achievement. How is Project Rainier differentiated, and what does it mean for customers? And critically, will they expand this bespoke model beyond Anthropic?
And Jassy focused the answer on the engineering and physical deployment achievement?
Right. He defined Rainier as a massive infrastructure feat, building a cluster of 500,000 chips, scaling to 1 million. That's an engineering challenge most companies could not achieve. The differentiation is the combination of that infrastructure mastery with the performance of the Trainium 2 chip itself.
And the plan is to offer this to others.
Yes. While Rainier is specific to Anthropic initially, Jassy confirmed that AWS plans to offer large, dedicated Trainium clusters to many other customers, starting with the rollout of Trainium 3. Moving on to the second round of Q&A, we shift focus back to the core retail business and corporate structure. Our first question here comes from Mark Mahaney, Senior Managing Director.
Mahaney had a crucial two-part question concerning groceries and headcount. The grocery question was pointed. Does the success of same-day perishables negate the need for Amazon Fresh physical stores?
The numbers that Jassy provided on the grocery side were absolutely eye-opening. He stated that the total grocery business, excluding Whole Foods and fresh stores, so just consumables and general store items, is already over $100 billion in gross merchandising sales.
Wow, 100 billion. That's a top 3 U.S. grocer right there, just from their website.
Exactly. Jassy stressed that they will continue expanding Whole Foods and experimenting with physical formats. However, the true enthusiasm was for the same-day perishable delivery. He called it a very compelling game changer.
And he was very confident this is actually changing the habit of the weekly stock up.
It is a habit alteration. They've extended this to 1,000 cities and expect to be in 2,300 cities by year-end. This strategy prioritizes network leverage over pure physical expansion.
Mahaney's second question was about the recent headcount reductions. Were these purely driven by AI efficiencies?
Jassy offered a strong cultural and organizational answer. He made it very clear that the recent role eliminations were culture-driven, not primarily financially or AI-driven. Not yet, anyway.
This speaks directly to the famous day one culture.
Exactly. He stated that the leadership team is committed to operating like the world's largest startup. This means removing layers, increasing ownership, and ensuring the company remains lean, flat, and fast, especially now.
Next, we heard from Eric Sheridan, managing director at Goldman Sachs, who focused on the deployment of physical AI robotics and automation across Amazon's vast operations.
Sheridan asked about the opportunity these investments present as a driver of efficiency and, crucially, as a source of capital that can be reinvested back into the business.
What was the long-term vision for their fulfillment network, fully automated?
Not fully. Jassy confirmed that robotics investment will continue to be significant. The long-term goal is a sophisticated fulfillment network where robots and humans complement each other and work together. The cost savings generated from automation are what allow them to keep lowering prices and speeding up delivery. Our final question in this round, and a highly forward-looking one, came from John Blackledge, Senior Equity Research Analyst at TD Cowen, regarding agentic commerce.
This is truly looking ahead 5 to 10 years. Blackledge asked how Amazon is thinking about autonomous AI agents purchasing goods on behalf of customers.
Jesse's response was highly optimistic about the potential for agentic commerce to fundamentally expand the overall volume of online shopping. He believes AI will make the online experience for shoppers who don't know exactly what they want better than it is in physical stores.
They are obviously developing their own solutions, like Rufus, but the focus here was on how they interact with external third-party agents.
Yes. Jassy said they expect to partner with third-party agents, but he noted that the current customer experience through those agents is, quote, not good. He cited lack of personalization and inaccurate delivery estimates as major issues.
So what is Amazon's condition for partnering? This is the right exchange of value he mentioned.
The condition is twofold. The partnership must lead to a better customer experience, and there must be a right exchange of value for Amazon, meaning they get their cut. He's confident Amazon will ultimately win because it offers the selection, value, speed, and reliability that any good agent will require. For our final deep dive into the analyst Q&A, we return to the dual powerhouses of AWS and advertising acceleration with Colin Sebastian, a managing director at Baird.
Sebastian delivered a crucial two-part question. First, how much of the AWS acceleration is core enterprise migration versus AI workload monetization? Second, disaggregate the advertising acceleration. How much is core advertising versus DSP and Prime Video?
Let's start with AWS. Jassy confirmed strong momentum in both AI and core services. He noted that they are still earning the lion's share of major enterprise transformations, moving from legacy on-premises infrastructure to the cloud.
So the core business is still growing strong, even with all the AI hype.
Absolutely. The core cloud migration trend is far from finished. And that makes the expansion of services like AgentCore critical. It was built to address the difficulty customers were having securely deploying agents. Jassy explained it provides the necessary primitive building blocks for this new era.
Now onto the advertising side, where growth hit a blistering 22% year over year. What was the breakdown of that success?
Jassy confirmed that every single advertising offering grew meaningfully this quarter. He attributed this success to Amazon's unusual full-funnel offering. This is the key insight. They can manage the entire customer journey, from awareness on Prime Video all the way down to a purchase via sponsored products.
The key differentiation here is the link to actual purchases and measurement, which most other platforms simply can't match with the same precision.
Exactly. When you layer in Amazon's superior audience curation and measurement, it leads to a return on ad spend that is very unusual. Looking forward, he identified three massive areas for continued growth.
What are they?
One, the store's business opportunity, as 80% of retail is still physical. Two, video. Prime Video and live sports advertising are still early stage. And three, DSP maturity. The demand-side platform is growing really quickly now that they've closed feature gaps and signed those big partnerships.
That concludes the analyst Q&A portion of our deep dive. We covered everything from the technical specs of their custom AI chips to the cultural reasons behind the corporate restructuring.
It was a dense exploration, but the narrative is remarkably coherent. Amazon is executing a strategic pivot unlike anything we've seen.
Time to synthesize the main themes and provide the contextual so what insights for you, the learner. Let's start with the loudest, most financially defining signal from the entire call.
The single loudest signal, theme one, is the capacity and capital commitment. The sheer scale of the $125 billion capex for 2025 and the explicit guidance that this will increase in 2026 tells you everything. This is Andy Jassy's definitive answer to the AI infrastructure war.
They must not be constrained by demand.
Precisely. It's a massive multi-year bet on AWS continuing to dominate the compute and training infrastructure layer, leveraging their custom silicon advantage and their ability to deploy physical power capacity faster than anyone else.
They're prioritizing scale and speed over short-term margin optimization.
Theme 2 revolves around retail efficiency and grocery transformation. The shift is subtle but profound. It's no longer about whether Amazon can sell groceries. It's about Amazon successfully changing consumer behavior.
Right.
The success of same-day perishable delivery, expanding to 2,300 cities, signals they are moving beyond the traditional model of building massive, dedicated physical grocery stores in favor of leveraging their existing, superior logistical network.
This efficiency push also ties back to the corporate structure discussion. The culture-driven headcount reduction is designed to ensure the human capital is as fast and agile as the physical capital they are deploying.
And our final major theme, theme 3, is the full funnel advertising maturity. Advertising's consistent acceleration at 22% year over year is confirmation that linking awareness on Prime Video down to a point of sale with sophisticated measurement works and is now yielding enormous high-margin returns.
The maturity is evident in the strategic partnerships with Netflix, Spotify, and Roku. These deals demonstrate that their DSP is no longer just a way to advertise on Amazon.com. It's a fully featured, competitive player in the digital ad space.
Exactly. They have moved from being an e-commerce adjacency to a core digital advertising giant.
So what does this all mean? What's the final provocative thought for you, the learner, to take away from this comprehensive deep dive?
What stands out here is the unparalleled pace of simultaneous innovation and deployment across the entire company. They are optimizing the mundane, the 80 million uses of a simple add-to-delivery button, right alongside scaling the futuristic, building 500,000 custom AI chips in Project Rainier.
The message is simple. Massive investment is being monetized quickly, powered by a clear, sustained, and highly defensible technological advantage.
Exactly. And if you are mulling over their future strategy, the greatest insight is the trade-off discussed in the Q&A, the commitment to custom silicon versus reliance on third-party chips. Their dedication to achieving that 40% better price performance is the core engine that will drive AWS adoption in the long term. That efficiency will dictate who wins the inference war.
That's a perfect thought to leave with. Thank you for watching this deep dive into the Amazon Q3 2025 earnings call transcript.
We hope this structural breakdown provided you with the quick, thorough, and highly contextual knowledge you were looking for.
Before you go, please show your support for this content by clicking the like button, sharing this video with your colleagues, and hitting that subscribe button so you stay tuned for our upcoming deep dives.
Until next time, keep digging past the surface.
Yeah.